Good morning, Jonathan Camarda, Chief Investment Officer. As we roll into mid-April, so what do we have? We have earnings on deck. We started with some of the large bank earnings at the latter portion of last week and look pretty attractive. Obviously, we won't go into the individual names. However, that was really just the superficial level because the large banks have been already predetermined to be in pretty decent shape. It's the regionals and deep regional earnings that we'll be looking for as far as to see the health of that sector of the banking sector. And so as we look further, though, let's dive in. Fed minutes, broader economic views, and then where that drills down for strategy. So first off, Fed minutes, pretty much a consensus among all the officials. 25 basis point hike is what they're looking at. There were some members on the last hike in March that would have held back, but it went through anyway. Some of the reading through the notes there, it's almost as if the initial banking little mini crisis that we had, little tremors there, were almost brushed aside. If you look at some of the comments there by Jerry and such there, we're looking at very poor risk management on SVB Bank, et cetera, which we already pointed out. However, we're not sure that, that's it, that there's nothing else in the cards. See, again, a lot of these talking heads on TV, no recession, banking situation. These are the same people that brought you inflation is transitory. So we take that with just a little bit of grain of Morton salt. There's a little advertisement there. Hopefully compliance leaves that in. Moving right along now from an economic picture from that standpoint. What are we looking at? Well, inflation came down from 6 to 5%, which is good. Biggest drop we've had in a couple of years. However, that 5% level we've been above for 23 months, so that's pretty significant. So some weaknesses that we're looking at in the economy, obviously the regional banks, those have been the punching bag here over the last couple of months. Some other areas that we've looked along with the financials and as such, commercial real estate, the housing market. Again, you look at, getting hit there. Of course, commercial real estate, we have $1.5 trillion with a T mortgages coming due over the next year and a half into 2025. All that while vacancies in the largest cities are at their highest level. In fact, subleases are now the primary way of getting that office space leased in some of the largest cities, which is obviously a big hit to profit margins for the companies out there. So that is of note as well. Things to like right now, very interestingly, of course, year to date, technology stocks have outperformed. One of the reasons they were so hard hit last year. So when you look at the performance of a NASDAQ, for example, year to date, keep in mind, well off the highs from the beginning of 2022. A lot of damage there. However, on the good news front is a lot of those companies have great balance sheets, cash flow statements, income statements, and are healthy, don't need to borrow money like some of your other sectors and as such, your financials, your industrials, et cetera. So they've actually done well as well. So double-edged sword on that one. But plenty of weaknesses out there, across the board, as we mentioned, across the sectors. So it is a bifurcated market. Earnings, we've already been drummed into our head by those talking head, the wonks on TV, talking about how this is going to be a dour earnings outlook session, as we move through the month. Now, what if it isn't? What if there's some actual positive speak? Perhaps the market could levitate. As we've spoken before, April's a second performing month behind November in pre-election years, and generally a pretty positive month as we roll into May, which is another subject, and we'll get to that next month. Let's not push it. No rush, right? And so as we move along, though, and we build on that, it'll be interesting to see what some of these CEOs have to say. This week is a huge week. Again, we don't get into the specificity of companies, except when we're talking layoffs and stuff like that. And we did mention, for example, McDonald's a couple of weeks ago, joining the big tech companies and laying people off. And yet you hear, again, a lot of these high-ranking Fed officials that are talking about, well, we don't really see a recession for 23, or some of these hedge fund managers, I won't name the names. We don't see a recession, or not this year, maybe 2024. But very interesting as we continue to see that inverted yield curve, right? Short-term yields higher than the long-term yields, portending of weak growth, to say the least. And then these massive layoffs that seem to belie the jobs numbers, which again, we've already talked about the frosting on those part-time jobs that have elevated those to a large extent. Although those even came back on the last reading, obviously. A couple hundred, was it 236,000. All right, so when we look from that end, where do we see opportunities? Well, thus far this year, along with tech stocks and some of the strategies like your global macro and velocity raptor and as such, and to a lesser extent, the sector momentum as it shifts in and out of the market. We've seen treasuries do very well, especially in the long end of the curve and the short end of the curve. 20-year treasuries, though, coming under a little pressure, so we have to look at that to see, again, if rates continue to cooperate, allowing treasuries to go up. That means rates going down, right? And we've seen gold looking to break out of a multi-year pattern to the upside, hitting a little resistance at this point as well, and we've been taking advantage of that, especially in active capital preservation and more recently, global macro tactical. So as we ride through, as far as year to date, we see a little bit of resurgence in energy. Of course, the geopolitical supply situation caused a little spur there as well, so we shall watch that as well. And then we do see some institutional buying, though, in the U.S. dollar, which has obviously been on the mat for the past several months, again, allowing treasuries and gold to elevate. So we shall see if those patterns reverse. With that being said, strategically, again, we remain optimistically prudent in the sense that, again, we take advantage in many of the strategies of that 4.5% ballpark, 7-day yield, the annualized yield on the overnight Federal Reserve Treasury obligation funds there from Schwab that you see as well. Again, in the past, there was what they call TINA, right? We always talk about FOMO, fear of missing out. TINA, there is no alternative. Well, there has been an alternative. So when you look at your strategies in this little rebound that we've had, I say a little rebound because when you look at the long-term charts going back to 2021 into 2022, the market still has not broken through what it needs to break through in resistance to, again, call the bear market dead. Now, I did say October is likely the lows. Of course, I don't predict with any certitude like the geniuses on TV. However, the market still has a lot to prove to break to the upside because they're still well off the highs from 2022. And we talk about loss, what you have to make up in losses to get those gains back. So in other words, when you lose 40% on $1 million, right, you got to make 67% to get it back, right? Because when your $1 million goes to 400, okay, to 600 rather, to make 400 on that 600, that's a heavy lift. That's 67%. So that's why, again, for many of our clients are already in that stage of life where they've accumulated most of their capital. FOM, F-O-L-M, not trademarked yet, fear of losing more, supersedes FOMO, okay? And that's where we look at, again, from that situation where we always want to have that balance of risk management. So with that being said, if you have any questions, again, always mention on your particular risk appetite, or if you're retiring, or there's a change of income source. As I generally talk to my clients on quarterly calls, we try to find out if there's any life changes or anything that we should do to adjust from your level. On the macro level, though, we are optimistically prudent. Was that too hard to say? I guess on a Monday morning it is, but there will be no retake. But from that standpoint, what we're looking for, again, right now is to see if earnings can confirm that optimism, or as many of these bears, who, by the way, have been either short or totally out of the market the last several months. So does it become a self-fulfilling prophecy? A lot of these hedge funds and the such that have been out of the market keep talking for lower prices. Remember, the market doesn't care. I don't care how smart you are, what you want to happen. We've seen this with stock calls by these folks that for some reason, whether it's a CEO or political reasons or whatever, they want a stock to go down and they keep shorting it and talking about it, and they keep taking losses. So what we don't do is we don't tell the market what we want. That's like telling the ocean, hey, during a hurricane, can you lay off the 80-inch LED right offshore on my condo? No, just kidding, folks. But the fact of the matter is you can't tell the ocean what to do. You can't tell nature what to do. You can't tell the market what to do. So what we do is react quickly. And on that note, speaking quickly, we're done. Mercifully for you. Until next time, we appreciate your time, patience, and your trust. Stay frosty, and we'll talk to you soon.